Dear students, welcome to the second day of the revision for financial reporting. Yesterday, we covered the mock exam, the section A of the mock exam, and the first OTQ from section B. So now we're looking at the second OTQ that is going to be related to question 21 to 25. Okay, this is a really good question, and let's see what are the challenges. Like, one of the challenge that we can see here is related to revenue. Then there is something related to EPS, this ordinary shares element. Then there is this depreciation related. There is one issue related to sustainability report. Okay, so it's a good mix of questions. And let's first of all look at the questions, and then we can look at the main information. Okay, this is always useful to look at the questions first. So we have this first one: what adjustment needs to be made to revenue in respect of commission based sales by Harry? Okay, now here is this, without looking at the case, I could just tell you that whenever there is a commission based revenue, then it is only commission. Usually the questions would record the whole revenue, but we have to only record the commission part, which is relevant. Okay, so we will need to see what are the situations, what are the circumstances, what have they recorded, or if they haven't recorded anything. So what we can do. So what the bottom line is that we're going to only record the commission that is ours, okay, that the business has earned. We cannot record all the revenue. Fine. So this is just about it before we look at the other questions, because we will have to go through the information in the OTQ. Okay. So let's look at the second one. We have some idea now what we're dealing with. So as I identified at the start, that we will be dealing with EPS. So we do not have to calculate the EPS. We just have to calculate the weighted average. What is the weighted average number of ordinary shares to be used in the calculation of Harry Co's basic EPS for the year ended 30th of September 20x7. So when we look at the weighted average number of shares, and then we look at the basic EPS, the two issues that can arise in this situation is the bonus issue or the right issue. Okay, because the other issues would come under the diluted EPS. So this question, we will have to deal with either the right issues or the bonus issue. So whenever you see a question for basic EPS, you will always be encountering these two issues. Okay, so we will have to go through the information and understand. So let's see the next question. The third for this OTQ is related to the sustainability reporting. Okay, so this is the IFRS S1 that is related to sustainability related financial information. I believe we can deal with this question without going through the information, and there are certain questions which we can do. So this is a general question which is related to this standard. So which four of the following should be core content of Harry Co's sustainability report? Harry Co is about to make their sustainability report, and we have to identify which would be the content that they should uh, produce and present in the report according to this IFRS S1 general requirements for disclosure of sustainability related financial information. So this is a general question. So let's see what we are looking at. We are looking at the first thing. The options that are available are governance, carbon matrix, climate change, strategy, matrix and targets, risk management. Okay. So what really is required is the first thing is governance, related to like how the business is governed in relation to the sustainability reporting. That's one thing. We're not looking at carbon matrix. We are looking at general matrix and targets, which is here. So it is not specific to carbon matrix. Okay. There is no such thing related to climate change, but there is the item related to the strategy. Okay, the strategy that is adopted towards the sustainability reporting. And lastly, we have the risk management. in reference to the sustainability reporting. Okay, so these are the four things which we expect. So if you look at the options available, I will also discuss the ACCA rationale behind these points that will have help us understand, because this standard is not frequently discussed and tested. So it is best that we look at what is ACCA's interpretation. However, the options that we have selected are 1, 4, 5, and 6, which is 1, 2, 1, 3, 1, 3, 1, 4, and 5, 6. So the correct option is the last one, which has the 1, 4, 5, and 6. Okay, I would just like to go through the rationale so that you have a better understanding. So, okay, here we go. So here we go. This is important to go through this. That will help us understand this better. So here we go. This is yeah. The IFRS S1 refers to four areas of core content that entities should provide in their sustainability related financial information. The first one is related to governance. The governance processes used to monitor and manage sustainability related risks and opportunities. Okay, so that's one thing, that how the company is, or the business is governed in relation to the sustainability related risks and its opportunities. The strategy, the approach of managing such risks, okay, the risks related to sustainability, and the risk management, okay, like what processes have been used to identify, assess, and monitor the sustainability related risks and opportunities. Okay, and the last one, what targets are set. The entities have to set certain performance targets in relation to sustainability reporting, including the uh, targets towards they will be working to achieve. Okay, so these are the four things. So it is always best to look at what ACCA has provided. So I believe now it must be making good sense to you, and I believe this is fine. We could go back to the question. So we have covered this first one, which was general. It did not require any relation with the information. So let's look at the next question. Okay, so this is another one which is related to the fundamental characteristics. So what are the common fundamental characteristics of useful information, including in both IFRS sustainability disclosure standards and in IFRS accounting standards? Okay, so when it comes to the sustainability disclosures, okay, so what are the fundamental characteristics that we look for? Okay, let's any ideas? Could you people uh, make the right choice here? The first option that we have is the relevance and faithful representation. I would
Okay.
say the faithful representation is the most important fundamental characteristic. The relevance obviously is there. So the first option seems to be correct, okay? Because it has to have the relevance with the sustainability disclosures, and it should be presented faithfully, okay? So we have relevance in the second option, but there is verifiability, which is not the right fundamental characteristic. Relevance and materiality, it has got nothing to do with materiality and faithful representation. Okay, so this is good that we had two questions related to sustainability, and we had discussed them. So again, let's have a look at the ACCA. Both sets of standards use the same two fundamental characteristics of user information, that is relevance and faithful representation. Okay, so before we get into the really tricky stuff of numbers, let's get done with these theoretical aspects. Okay, so that's it. We are now all set to look at this next question. I hope we are comfortable with these two questions related to sustainability. I would just like your feedback before moving forward. The 25th and the 23rd and the 24th. Okay. Okay. Okay, that's good.
Yes.
These questions are good time savers in the exam. If you have a good idea of them, then you can save a lot of time. Another time saver is coming up. This is an easy question. I would like all of you to have a go at it, okay? This is a very easy. This is like a piece of cake. How should the change in depreciation method be treated in financial statements? Yes. Uh, Anyone? Should it be a prior period error with retrospective adjustment? As a change in accounting policy with a retrospective adjustment, as a change in accounting statement with prospective adjustment, a revaluation change with prospective adjustment. Okay. Yes. So okay, we've got two feedbacks. This is very easy. So the correct answer is okay. Anyone else? I've got two feedbacks. This is just easy marks. Okay.
Let's see. Go
Yes.
for option C. Yeah.
Right answer. It is very, very easy because change in the method of depreciation is an accounting estimate, and the it will always have prospective adjustment for the current period and future. Okay, it will never have the retrospective. So we're now done with the easier part. So let's now look at the because that's about it for this OTQ, and now we're looking at the problematic areas. Let's see. So now we'll be looking at one of the question was related to the EPS, and the other one was related to this revenue. Okay, so revenue is easy. EPS is a bit more challenging. So it has more working. So let's look at the revenue first. We have this commission based, and we have to see what revenue can we recognize. Okay, let's see. Okay, so we have revenue included in Harry's draft revenue is 20 million relating to machines sold to customer on behalf of a number of manufacturers. Okay, so they are selling machines worth 20 million on behalf of a number of manufacturers. Okay, so clearly they are not the ones who are selling them. They are, the intermediary, and they have this commission to be earned. Okay, 18 million is included in Harry Co's draft cost of sales. Okay, so they have also included the cost of those machines in their cost of sales, representing the amount payable to the manufacturers. Okay, so like they got this from the manufacturers, and they have to give it to the this amount to the manufacturers. Okay, they say this is the thing. The difference of 2 million is the commission that manufacturers have agreed that Harry Co can retain as commission. Okay, so this is the real revenue. This is the real revenue which Harry owns, and all the other things which Harry has included is not correct. Harry should not have included the total revenue. Harry should not have included the cost of sales because they haven't made it. They're only selling someone else inventory. Okay, so the only thing that they can recognize is this 2 million. So the issue is they've already recognized the 20 million, and they've already recognized the 18 million. So what we need to do is we need to kick out the 18 million from the revenue and the 18 million from the cost of sales because we need 2 million. So we already have 20 million. So if we get rid of 18 million from the revenue, and we cannot have anything as cost of sales, and we take that out from the cost of sales, this will solve the problem. Okay, so I hope this is clear. The manufacturers set the selling price of the machine and have the responsibility of repairing any faults with the machine after sales. So really, Harry has got nothing to do with it. Okay, the manufacturers set the selling price, and they also have the responsibility of repairing any faults with the machines after sale. So Harry has got nothing to do with this. Okay, so it is really a commission that Harry should recognize. Okay, so this was another straightforward. So overall, I believe this OTQ was quite straightforward, except if you do not have the understanding for the sustainability reporting, then you will be in trouble, and you could lose easy marks. So here we have. Let's see what adjustment we need to make. What adjustment needs to be made in the revenue in respect of the commission-based sales by Harry? Reduce the revenue by 20 million and reduce the cost of sales by 18 million. This is totally taking out. So we're not looking at that. We do not want to take out all the revenue and all the cost of sales. Increase revenue by 2 million. Already there is excess revenue. We cannot increase by further 2 million. Increase revenue by 2 million and increase cost of sales by 1.8 million. No, already they have included 20 million and they have included the cost of sales as 18 million. So this last one makes no sense. There is no increase in cost of sales. And then the last one that we have is we have this reduced revenue. So the revenue that is already recognized is 20 million. So if from that 20 million, we take away the 18 million, what is left is the revenue that they should have, and that is 2 million. Okay, so they will be keeping the 2 million and reduce cost of sales by 18 million. You know, the cost of sales will be totally made zero, and the remaining revenue is going to be 2 million. So option D, the fourth option, is going to be the correct one. Okay, so I hope this was easy to understand. We had a lot of discussion before, and now it's easy to pick the right option. Yes, people, I hope you people are fine and comfortable with this one.
Yes, it's clear.
Okay, excellent. So now we are about to attack the real one, which is the EPS related. Okay, so let's look at this thing. We already know that we have to calculate the weighted average number of shares to be used in the calculation of Herico's basic EPS. Let's go through the question completely so that we do not miss out on anything. So we're done with the revenue part. We're now looking at the ordinary shares. So at 1st of October, the year end is 30th of September 2027. And at 1st of October, Harry had had 36 million equity shares in issue. And on 1st of January 2027, Harry made a fully subscribed right issue of one new share for every four. Okay. So this is at the start of the year. Harry had 36 million shares, and on 1st of January, Harry made a right issue of shares at a price of 2.8 per share, and the market price of the equity shares of Harry immediately before the issue was 3.8. Okay, so this is the information provided, and we from this we have to calculate the weighted average number of shares. So let me just bring this part up so that we could deal with it properly. Let's just get it from here and let's just put it in front of the question so that we can understand it better. So here we go. This is the question. We are looking at the weighted average number of shares. So that is going to help us understand the details. So we are looking at the weighted average number of shares at 30th of September 2027, and the shares at the start were 36 million, and on 1st of January there was this right issue. Okay, so we have to do this thing in a way that we know how many months had we had the 36 million and when was the right issue made, and so that we could calculate the weighted average number of shares. So if the year end is September, the year starts in October. So October, or this will make things easy for you. October, November, December, and for these 3 months, okay, because on 1st of January, there were right issues made, okay. So for October, November, and December, they had the 36 million shares, and we could say that we do it for 3 by 12. That is easy. For January, February, March, April, May, June, July, August, September, and October. That sums up to the remaining 9 months. We had this 36 million, plus we had the right issues. So how many were there? Let's calculate the value for 36 million. For every 4 shares, we had a new one. Okay. So a new right issue. So let's calculate the value here. 36 divided by 4. It means that we will have to have 9 million more shares. Okay. I hope it is 9 million. It is not. Yeah, that is 9 because I've got these figures rounded up. So for these 9 months, there is going to be, we have calculated the value here, 36 million plus the 9 million. And we have this value. Yes, what does it sums up to? 45 million. And this is going to be for these shares were with us for the 9 months. Okay. So I hope this is clear now. This is easy so far. So now I'm going to bring the part that is going to twist the situation a bit. Okay. That is going to make the things interesting. Okay. So first of all, I will explain the logic behind what I'm about to do, and then things will make a sense. Okay. So let's get rid of this thing, and we have this working for it, which is equals to 9 million. Okay. Now, what is the issue here? Uh, we need to increase the number of shares in the first 3 months so that the the number of shares throughout the year uh, remain similar. Okay, this is the logic. Okay, so I will explain why we have to do it. You see, in the later 9 months, the number of shares have increased by 9 million, but in the first 3 months, the number of shares are only 36 million. Okay, so the whole point is that when we are trying to calculate the EPS, we need to have the the number of shares existing throughout the year to be same. Okay, because that affects the calculation of EPS. The logic behind is the whole concept is that, for example, if I just give you a small example, for example, in year ended, I'm just explaining this concept so that you can relate to it. In the year ended 30th of September X7, uh, there were no right issues. So what is going to be the impact on EPS? Can someone tell me this thing? In the year ended, or we could just say 30 September X6. In this year, there was no right issue. Okay. So what is going to be the impact on EPS? Okay. We are likely to have a high EPS. Okay. Because you see the number of shares were less. High EPS, uh, since the number of shares were few. Okay, what happens in year ended 30th of September X7? Uh, we have right issues, and the EPS will fall. Okay, so what is going to be the opinion? What is going to be the reaction of the shareholders? You tell me. In the previous year, the EPS was high figure. In the next year, 30th of September 2027, the we have made right issues. The number of shares have increased. Clearly, in the formula for EPS, we have this earnings divided by the number of shares. So if the number of shares increase, the EPS is going to, with the right issue, the number of shares increase equals to fall in EPS. Okay. So the investors are not going to like this thing. The investors are not going to buy this thing. They do not want to see their earning per share falling. Okay. So what are we supposed to do? Are we supposed to call all the shareholders and explain them our situation? No, we cannot do that. Okay. We have a lot of shareholders and we cannot explain the whole situation. So what are we going to do? We are going to reduce the EPS for the previous year, okay? So that everybody understands. This is completely logical. There is no creative accounting here. Okay, I hope you understand now that we have to make an adjustment in the previous period EPS so that things seem similar. Okay, do you understand this thing now? Yes, people, I have explained you the situation that there is no fault of the company that the EPS has gone down. The EPS is only going down because of the right issue. So now we have to give this idea to the shareholders. Okay. So we cannot educate all the shareholders. So what we do is we reduce the EPS for the previous period. Okay. So the same logic is going to be applied here. Like the number of shares in this period have increased. So and the number of shares in the previous period have not increased. So what we are going to do, we are going to calculate a fraction through which we are going to increase the number of shares in the first 3 months so that we have an even situation throughout the year and we have a balanced EPS. Is it clear? Do you understand the logic? If that is clear, then we can move on to calculate that specific fraction that is going to help us achieve the objective that we want. Yes, people, I hope you're still with me. So we have now the
Yeah, I don't know. Just as you were saying that it's not like a creative accounting window dressing.
exactly. Yeah, you see,
Yeah.
it makes complete sense. Okay. So let's see what is the next step that we are going to do. The next step is that we calculate the theoretical X right price. Okay, we need to have the price that is after the issue of right shares. Okay, so we have to calculate this thing that is the theoretical X right price, which we are going to calculate now, and we will be using the fraction calculated from this one to calculate the fraction to increase the number of shares in the first 3 months. Okay, let's see how do we do that. So we have this the price before the rights. The price before the right issue is dollar 3.8, and the right issues are made at dollar 2.8. Okay, so this is the situation. Fine. Now we are going to use these figures. So what happens is that we have 4 shares. Now you see, you know that we have got one new share for every 4 heads. So we have 4 shares, and before the right issue, the price of those shares were 3.8. We're going to calculate the value for those 4 shares. So let's see what is that value. 4 into 3.8. So let's unround these figures since we're going to use this column. We could have the exact values. Okay, so that is 15.2. And if we, let's just take it down. Okay, and we have got one new share, one right issue, and that is available at dollar. That is 2.8. That is available for dollar 2.8. So that is going to be 2.8. So the total value now in total we have 5 shares. And what is the total value of those 5 shares? Let's sum this thing up. That is going to be 18. Okay. So what is going to be the theoretical extract price? So the theoretical extract price is going to be $18 divided by 5 shares. I hope this makes sense. So we're going to calculate this as 18 divided by 5, and that is going to be the theoretical extract price. Let's unround this thing so that we have the value. So that is 3.6. Fine. So the theoretical extract price that we assume, what would be the price after the right issue? Now, let me just explain what is the meaning of theoretical extract price. You see, the price of the shares before the right issue was 3.8. The right issues were made at 2.8. Fine. Obviously, the right issues are made to the existing shareholders and they are given shares at a lower price so that we encourage them. I hope this concept, you understand this concept. So whenever the number of shares increase, the price of the share falls. Okay, so before the right issue, the price was 3.8. We made some right issues, the number of shares increased. A simple demand and supply rule that whenever there is something in large quantity, the price of that commodity falls. So clearly, the shares have lost some value. Before the right issue, it was 3.8, and after the right issue, it was 3.6. Okay, we cannot have the exact value. That's why it is called the theoretical X right price. Okay, so I hope you understand how we have calculated the theoretical X right price. All the information that I used here is from this calculation. The total value is 18. The number of shares are 5. So, what value that we have calculated is 3.6. I hope this is clear now. Yes, people. I hope you're with me. If you give me the OK nod, then I will move ahead with the calculation because we're almost done. Okay, I've got just one feedback. Okay, fine. So it seems okay. If anyone faces any problem, I can explain it again. But I believe so far, if you are following me, if you are with me so far, things will be fine. So before moving on, I'm just going to clear the drawings here and I'm going to move on. So coming back to the situation, we had this situation here that in the first 3 months we had fewer shares. In the later 9 months we had the right issue and the number of shares have increased. So what we planned, we had to increase. I wrote it here. We need to increase the number of shares in the first 3 months so that the number of shares are even throughout the year. Throughout the year they remain similar. Okay, so we can use the word the number of shares throughout the year remain even. Okay, so we achieve some kind of parity here. Okay, so how will we do that? What is the process through which we can do it? Whenever we are dealing with right issue, we are, you see, since we have to increase the value, so we multiply it to 3.8, which was the price of the shares before the right issues, and we multiply this to 3.6. When we multiply it to this fraction, what will happen is we will achieve the increase in number of shares. Okay, so you have to use this fraction intelligently. You see, you know the objective. What is the objective? We discussed it here, that we need to increase the number of shares, and we have two values: the shares, the value of the shares before the rights, and the value of the shares before after the right issue. So clearly, if we multiply it to a higher value and we divide it to a lower value, we will have increased number of shares. Okay, I could just explain this to you, that before this fraction, the simple calculation would be 36 million. If we just assume we do not apply the 3 months rule. So if it is 36 million, but if we multiply this 36 million into 3.8 divided by 3.6, let's see what value do we arrive at. So 36 into 3.8 divided by 3.6. The number of shares have gone up from 36, they have gone up to 38. Okay, so clearly we have achieved the objective. Okay, I am just doing it to show you the whole process. So this is the treatment. So we are going to take 36 million multiplied by this situation existed for 3 months only, and we're going to increase it since the number of shares for the later 9 months have increased. Okay, so we will multiply to this fraction. Okay, I hope this makes sense. I have broken everything down so that it makes complete sense to you. Okay, so I have tried to explain things in detail so that you also understand. It was not only about discussing the mock. I tried to explain the concept behind it so that you develop a deeper understanding. Okay, so I'm moving on now, assuming that you are with me. Yes, people, before you move on, I am just pausing to take your opinion that we are all fine. Okay, so I believe this is fine. Let's just multiply the fraction here. So for the first 3 months, the weighted average number of shares, I've already written the fraction here. Okay, 36 million into 3 by 12 into 3.8 divided by 3.6. Let's see what value do we have. 36 into 3 by 12. We do that. So that is 9. Let me just unround the figure. I want to have the precise value here. That is 9. And if we now take this 9 into 3.8 divided by 3.6, so that is how we calculate the value. So without this fraction, the number of shares were 9. After this fraction, the number of shares have increased to 9.5 million. And the situation for the later 9 months is we had the 45 million. I've already calculated the value for you. The initial shares plus the right issue, 45 million, multiplied by 9 by 12. Okay. So we do not need to make any adjustment here because this part of the year already had the higher number of shares. Okay. So the weighted average number of shares is going to be the sum of these two values. So we add these two. Let's take the sum of this 9.5. This is 9.5 existed in the first 3 months and 3.75 existed in the later. So let's unround the value, and the answer is 43.25 million. This is how you calculate. Okay. So I believe this is clear. That is the answer that we're looking for. So this is only one situation of EPS. EPS has total 5 situations, and my plan is to discuss all the situations in tomorrow's session. Okay. So we might not discuss the right issue anymore because we've already discussed that in detail. But the logic is here. This whole logic will be prevailing in all the situations, and if you understand this logic, this principle, then you will be comfortable. That you see, we have to have a smooth thing, and this does not refer to creative accounting. This is to make sure that the shareholders do not react because there's nothing bad going on. It's a rational thing that we have given new shares. Obviously, the EPS is likely to fall. Okay. Yes, students, if you are comfortable, we can go to the options and select the 43.2 million. We only had to calculate the weighted average number of shares. What is the weighted average number of shares? Anyway, we do not have any option, so that is the answer, 43.25 million. Okay. Are we good to go?
I joined late, sir. So, um,
I hope you understand the calculation.
it was very late. I'll watch the recording, so I
Okay,
can't really
no problem,
comment
no
much
problem.
on it. So.
Yes, what about others? I take your silence as you have agreed. Okay, so if there is any issue, you can just let me know before I proceed because I'm waiting for your feedback. I do not want to rush into things. I want that you people understand it properly. Okay, I've got one feedback. That's good. You people should watch the videos again if you people are uncomfortable about it. So we now move on to the next one. I had to discuss these points, although we have covered the related questions. But let's see. Let's go through what they're mentioning here. At 30th of September 2007, Herico reviewed its depreciation method and useful lives and elected to change the depreciation of machinery from 10% on straight line to 11% on reducing balance. Okay, so the question that we have attempted related to it is that since Harry has changed the depreciation method, a change in the depreciation method, a change in the estimated life, a change in the residual value, these are all estimate changes, and you do the prospective adjustment for them. You never do the prior period retrospective. Okay, so this is the question that we've already done, that for this we only do the future adjustment, that is prospective. The next thing that the two questions that we did for the sustainability report, The directors of Harry Co. have decided to prepare a sustainability report for the year ended 30th of September 2028. However, are unsure about the requirements of the IFRS sustainability disclosure standard. So we have understood the four disclosure details that the directors of Harry should consider when they prepare the sustainability report. Okay, so we did those MCQs in detail, and we looked at the feedback from the ACCA, okay, the rationale that they gave us. That was governance, strategy, matrix, and targets, and the risk management, okay, the matrix. Okay, so I believe we are comfortable with this one. We have concluded this OTQ. Let's move on to the next one. The next OTQ has deferred tax in it, and it has the deferred tax related to two issues. It has leasing as well. So let's attack it. Okay, so it's going to be good fun looking at this one. So let's see, we have this guy Hickson, and let's see what Hickson is up to, and we can understand. Again, I would follow the same approach. I would go through and we also have this sales contract. Okay, another question that is related to revenue. So we have these two issues. Okay, what a feedback. Yeah, the recorded videos will be available on VLS site and also on YouTube. Okay, the yesterday session is available on both the mediums, the VLS site and the YouTube, and this today's session will also be uploaded. Okay, so don't worry about it. Fine. So let's see. I would just like to go to the questions first before I look at it. Okay, so this is we will have to go through the information. Which statement is correct regarding the accrued expenses? So they have tested the expenses, the accrued expenses in relation to the deferred tax, where they are discussing the deductible temporary differences and so on. Okay, so we will be ignoring this for the time being because we will have to go through the whole information. And we go to the next one. Let's see what is the next challenge. The next one is again the deferred tax. What is the deferred tax charge to profit or loss in relation to PPE? So again, we will have to go through the information. What is the information available? What are the temporary differences at the start? What are the temporary differences at the end? And we're going to calculate them, and we're going to multiply that to the tax rate to calculate the deferred tax charge. Okay, so that is going to be easy. So we see that the first two questions are related to deferred tax. The third one that we have is related to, let's see, I believe we can do this thing without looking at the information because this seems to be a general question. Which statement best reflects the accounting treatment that Hickson Co. must apply when it adopts the revaluation model? Okay, so this company is about to adopt the revaluation model, assuming that the fair value of property remains in excess of carrying amount. Okay, so here we have this thing that they're following the revaluation model, and the fair values of the property are in excess of the carrying amount. Clearly, when such a situation arrives, we have to calculate the revaluation, we have to recognize it, and obviously this leads to the temporary differences. Okay, because this, you see, this is the third consecutive question that has deferred tax in it, the deferred tax implications. This is a general question, so I will just go through the options. So as I've already said, that whenever we have this revaluation, the revaluation goes to the other comprehensive income, and this raises the temporary differences because this increases the carrying amount, and the tax authorities do not accommodate the this revaluation. So the tax base of the assets, the tax base of the property will remain the same. Okay, however, the carrying amount will increase. So clearly there will be deferred tax implications. Okay, so let's see the first one. The initial revaluation surplus is recognized in other comprehensive income and gives rise to related deferred tax income, which is recognized in profit and loss. Okay, so this is not correct here, because when the carrying amount increases as compared to the tax base, this generates a deferred tax liability. Okay, so this first option is not correct. However, this part is okay. That it goes in the OCI, but the later part is not correct. Okay, let's see. The revaluation surplus gives rise to taxable temporary differences, as I've just explained, that your carrying amount is going to be increased, but the tax authorities do not increase the tax base. So clearly, there is going to be a temporary difference. Okay, obviously it will be settled when the asset is gone, when the asset is done with its useful life. Both the carrying amount and the tax bill will become zero. So it's a temporary difference. It's not a permanent one. And related deferred tax is recognized in OCI. Okay, so here we have this thing that whenever such a thing happens, the related deferred tax is recognized in OCI. Okay, so this is the one that is the correct option. We have calculated that whenever the revaluation takes place, temporary differences arise and they are reported in OCI. I hope this is clear. We now look at the other options as well. The revaluation surplus has no deferred tax effect. This is not correct. Okay, the revaluation will have the deferred tax consequences, and that is going to the deferred tax related to revaluation is debited to the revaluation surplus. Okay, so let's move on to the last option. The revaluation model is applied retrospectively. Okay, so this is not correct because this revaluation is the change in estimates and the PPE, and the deferred tax at 30th of June 2028 will be restated. Okay, so there is no such thing. We do not have to restate the opening value. So this last option is also not correct. I hope this is clear. This was a general question. We could do it easily. So this is easier way through which we could. So we have this third question done. We have to deal with two questions related to deferred tax. Okay, excellent. So let's see what is the next challenge here. So that is the fourth one for the OTQ. Let's clear the drawings before we look into it. Okay, here we have this lease liability. Okay, so this is another question that can be done without looking at the information. It's a general question. Which of the following correctly describes the initial measurement of lease liability? Okay, so what really counts as the lease liability? So the basic idea that two people have is the present value of the lease obligation. Okay, so that is the fixed lease payment. We can include the variable lease payment, but there are certain conditions which have to be met. So let's see, and if there is any termination any termination penalty that is there, so we are also going to include that. Okay, so let's look at the options. Now you have the fair idea, like how do we calculate the initial lease liability? That is the present value of the fixed lease payments and the termination penalties. Okay, so let's see what is the right option. Let's look at those options. Now you have some idea. So the first one, how do we value it? At the present value of the fixed and variable lease payments. Okay, so this variable lease payment is only recognized or only considered as initial measurement if it is related to a fixed index. Okay, so it is subject to certain conditions. So if those conditions are met, only then we could recognize the variable lease payment. Okay, however, there needs to be the termination penalty as well, which is missing in this part. So that's why we say that this is not complete and not correct. Okay, this first explanation. The second one, at the present value of the fixed lease payments, the termination penalty and the installation cost. Okay, now this installation cost is not to be included because we are not calculating the right of use of asset. Whenever we are looking at right of use of asset, only then we would have the installation cost. Okay, any cost which are directly related to that asset. Okay, so this part is okay, this part is okay, but this part, the installation cost, is not okay. So this is also gone because we're not looking at right of use of asset, we are just looking at the initial measurement of lease liability. Okay, the third one rather, at the present value of the fixed and lease, again, I told you that this we need to have more information on the variable lease payment. And we cannot have the installation and the legal fees. Okay, so we come to the last one. This is probably the right one. At the present value of the fixed lease payment and the termination penalty. So this is what we have been discussing. Okay, so it has some mixtures. We omitted the variable lease payments for a reason, and we also omitted the other costs which are related to the asset. So I believe that if we look at the ACCA feedback, that is going to enhance our understanding. Okay, let's see. That is related to this question 29. That is going to help us understand it better. Let's see. So we have this. What is the rationale provided by the ACCA? So they say that this is the at the present value of the fixed lease payment and determination penalty. So what is the rationale? The lease liability is measured at the present value of fixed lease payments less any incentives, if there has been any incentives already received. There was no mention of this in the options. The variable lease payment only if, so this is important to identify, which I was explaining, that only if they are fixed in substance or related to index or related to a specific rate. Okay, so in the options there was no such condition, so that's why we ignored the variable lease payments. And then comes the exercise price of a purchase option if reasonably certain to be exercised. Early termination penalties if termination option is reasonably certain to be exercised. Okay, so this is the this thing is included in the your initial lease liability. Let's look at the other parts, the cost that we skipped. Okay, so we skipped the initial direct cost, are not included in the lease liability, but are included in the measurement of right of use of asset at commencement of lease. Okay, so there are two issues in IFRS 16 which are in the syllabus. One is the present value of the lease obligation, and the other thing is the right of use of asset. So all the direct costs that we did not include it related to right of use of asset. Okay, so I hope this has helped you understand this question better. Okay, so I don't think it was an easy one. You had to knew the variable payment element, and you had to be sure of the what value goes to the right of use of asset and what goes into the lease liability. Okay, so I would like to go back. So let's see what is the last question. The last question is related to what revenue should Hickson Co. have recognized in the year ended 30th of June 2026 in respect of the sale. So clearly, we need to look at the information for this one. Okay, let's see. So we are looking at the two deferred tax questions for which we need information, and one of the question related to revenue. Okay, so this is the whole question now. So we have sorted out two of the questions. Let's see. Okay, here we have this situation for the deferred tax. Let's see. Hickson Co. has prepared draft financial statements for the year ended 30th of June 2026. Adjustments are still required in respect of deferred tax and errors. So we have the draft financial statements, and there are some adjustments which are required for the deferred tax and the errors. The following information is relevant. The first one is that we have this accrued expenses. What is related to accrued expenses? The statement of financial position includes an accrual for expenses with a carrying amount of 2,560. The expenses were deducted from profit in calculating the current tax charge for the year. Okay, so here we have this statement that there are some accrued expenses of 2,560. However, while calculating the tax figure, we included those expenses. Usually what happens is that the tax authorities would only go for the cash basis and they would not consider the unpaid part. Okay, but the accounting goes for the total expense for the period. Okay, but here they say that the tax that has been calculated includes this part. Okay, so clearly this shows that there is going to be no temporary difference, because the tax that has been calculated already includes the accrued part. Okay, I've explained you the situation, like what is the usual. The usual is that the tax authorities, the tax base of the expense would be the cash, but and the business would obviously is following the accrual basis and the matching concept, and they would consider the whole expense. Okay, but in this case they say that the expense that has been calculated for calculating the current tax for the period included the whole expense. Okay, the expenses were deducted from profits in calculating the current tax. So it means there is no issue, there is no problem for the temporary difference. Okay, so let's see the options that we have so that we could understand. So this was the first question that we skipped, and now we have read the relevant information, and now we can attempt it. Which statement is correct regarding the accrued expenses? Okay, the accrued expenses have a tax base of nil and give rise to a taxable temporary difference. So I've just explained you that in this specific case, since the calculation of the tax expense is also based on the total expense, so there is no difference in the tax base. Okay, so this is not the case, so there is going to be no temporary differences. So this first option is not correct. The second one, the accrued expenses give rise to deductible temporary differences, and it leads to a deferred tax liability. Again, this is not correct, because we figured out, the information is provided that they were considered while calculating the tax expense. The accrued expenses have a tax base of 2560, and there is no temporary difference. Okay, so this option is correct, that they have a tax base similar to the accounting carrying amount for the accrued expenses. Okay, so if the tax base is 2560 and the accrued in the statement of financial position is also 2560, then there is no temporary difference. Okay, so clearly this is the right answer. And if we look at the next one, the tax base of the accrued expense is equal to the carrying amount, resulting in a deferred tax liability. Okay, so this part is correct, that the tax base and the accrued expense is equal to the carrying amount. So how can it result in a deferred tax liability? So this later part is not correct. Okay, so this was a straightforward one. We simply had to see how the treatment of the accrued expenses is done, so we can understand it. So it was a simple one. We have a more challenging one where we have the temporary differences at the start. So let's go and look at that. I hope this one is clear before we move on. So I am looking at this next one. Okay, here is the next issue related to the deferred tax. Let me show you the whole question. Okay, we have this PPE, property, plant, and equipment. And in the draft statement of financial position, PPE has a carrying amount of 196,500. Its tax base has been calculated at dollar 152,300. Okay, so the carrying amount is higher, the tax base is 152,300. Okay, the taxable temporary differences related to property, plant, and equipment at 1st of July 20x5 was 30,120. Okay, so this is the taxable difference at that date, at 1st of July 20x5. Hickson Co. management have decided to adopt the revaluation model for property with effect from 1st of July 20x6, and estimates that the fair value of property is 85,000 in excess of its carrying amount. Okay, so we have a certain value, a certain difference in the temporary differences at the start, and then there is the revaluation taking place as well. That is taking effect from 1st of July 20x7. Okay, So this is the whole information. We have some opening temporary differences that leads to the opening liability, then something changes in between. There are some the taxable temporary differences related to property at 1st of July 20x5 of 30,120, and later at the like at 1st of July 20x6 they have gone for the revaluation model, and this has resulted in a revaluation gain. Obviously this raises the increase in the carrying amount and the start of the further temporary differences. Okay, so this is the information. Let's look at the question. I would like to bring the question in front so that we could have a better understanding. Let's see the question that we have related to it. That is, it will make it easy to comprehend. Otherwise, will have to scroll up and down. The relevant question is here. Okay, that is. Let's see. So that is the information. So it will be easier to deal with this. This is related to people. Okay, so here we go. So what we have to look at is the situation at the. So we're looking at the situation at 30th of June 2026. Okay, so what this means is that this change that took place from 1st of July 2026, we're not going to consider it right now. Okay, because you see, what happens here is that this is happening on 1st of July, and the question requires us the information. What is the deferred tax charge to profit or loss in relation to the property, plant, and equipment in the year ended 30th of June 2026? Okay, and this change in the policy to adopt the revaluation model is taking effect from 1st of July, and we are required to calculate the deferred tax charge at 30th of June 2025. So we are not going to consider this 85,000. Okay, so I hope this bit of part is clear to you before we go any further.
I'm following, sir.
Very good. So let's see.
Yeah.
We now look at the opening, deferred tax liability that is based on the temporary differences. So how are we going to calculate that? The carrying amount at the start is 196,500, and the tax base is 152,300. Okay, so we take the difference of the two, and we have the temporary differences. So we take the difference here of the two values, 196 minus this 152. So these are the temporary differences, and we have the deferred tax liability related to that. So let's the opening. Let's bring that thing down here. The opening deferred tax liability would be the temporary differences, which are 44,100 multiplied by the rate. The tax rate, I think we will have to go down to scroll down to see the rate that is. Okay, here is the Hickson co-pays tax at 20%. Okay, so to calculate the deferred tax liability, we have to multiply the temporary differences to the tax rate. Okay, so that will help us calculate that value. So that is 20%. Okay, so let's see. We have this 44, 220%. So this is the opening situation. And what is going on during this year? There has been an increase in the temporary differences. The taxable temporary difference relate to PPE at 1st of July was 30,000. 120. Okay, so this is the situation, and this is the opening figures that we have had a carrying amount of this value, and we had the tax base of 152,300. So now we're going to take the temporary differences of 30,120, and we're going to take the value. So that is the opening value, the 30,120, and then we can compare it to calculate whether we have the charge or credit. Okay, so let's see. We need to just take this thing down. The 8440. We could just say this. The deferred tax. That would be the value, and let's put it the whole thing down so that it makes more sense. So the temporary differences difference at the start would be this 30,000. As they say, this is at 1st of July, okay, because we're looking at this value at 30th of June. So they have given the opening difference here as 30,120 multiplied by 20% in the tax. So the opening value is 30,120 multiplied by 20%. And the deferred tax that is at the end, the differences at the end are 8840. So we have to take the difference, the increase in the temporary differences lead to deferred tax charge. This is what is required. So we take the difference of these two. We have this. They have become 8840, and we deduct the opening one 6,024, and we will have the deferred tax charge. So let's calculate the value here. This figure minus the 6. So that is 2816. This is the value that is going to be reported as deferred tax charge. Okay. So this was a tricky question. It gave us a lot of information. Most of it was mixed up. Like they have given us the opening value, but they gave us the differences as if these were the opening value. And later on, they told us that at 1st of July, the opening differences are these one. And then to confuse the students further, they gave this information which was totally useless for this question. They gave the impression that they have got some new revaluation on 1st of July. And it is important to look at the requirement that we wanted to calculate the deferred tax charge or credit at 30th of June. Okay, so this was a trick question. This information was totally useless. This information was opening, and this is what happened at the end. Okay, yes.
Yeah, how do we arrive at I'm just looking at the 20%. So we apply to the temporary difference and deferred tax liability, and I'm looking at the question to see where we got that from.
The 20%, yeah, that is I scroll down because the tax rate is usually provided at the end. Okay, so I just scroll down and bring that part up here. This is the later part of the question, and it has at its bottom Hickson pays tax at 20%. Okay, so this is the whole question.
Okay, thank you.
So I believe we are comfortable with this one. So we have done the deferred tax part, and we only have this one part left, which is related to the revenue, the sales contract. Let me bring the question first and then understand. I hope this is clear. This was a trick question, seemed simple, but it had variety of information that made it confusing, okay? And some of the information was totally useless. So we have this lease charge to deal with and the other sales contract. So let's go through those questions before you people give me the nod that it is fine. Yes, people, are we comfortable?
Yes, sir. I also had the same question where the 20% was coming from. Otherwise, it's all good.
Very good. That's good. So now let's look at the sales contract, they have this question, because we've done the leasing part. All this information is not making any sense because they made a theoretical question out of it that was related to the initial recognition of the lease liability. Let's look at the sales contract part. I will bring the question up to make you understand, so that that is related to this. That is the lease liability part, and this is the part which is related to the recognition of the revenue. So let's take it up there so that we have the related information in front of us. Okay, here we go. So that is the question. We will go through the question and have a better, deeper understanding so that we do not get confused. Okay. So the requirement is, what revenue should Hickson Co. have recognized in the year ended 30th of June 2026 in respect of the sales contract? Now here is the sales contract information that we're going to relate to it. So let's see what revenue they should recognize. On 1st of March 2026, that is during the year, because the year end date is 30th of June, Hickson Co. sold 1,000 identical items to a customer for a total of $12,000. Okay, they have made these sales on 1st of March, offering 6 months credit. Okay, so it's a 6 months credit, which means we do not have to do any of the working. It's a 6 month credit, and Hickson Co. agreed to hold the goods for the customer until required. Okay, so there was this arrangement between them that Hickson Co. is going to hold the those items. Okay, until required, up to for up to a year, as the customer has no storage facility. Okay, so Hickson Co. holds the goods in a separate area of its storeroom, and they are identified as belonging to the customer and available for immediate delivery. Okay, so those goods are set aside separately, and they are identified as they are sold, they belong to a customer. Okay, so and they are available for immediate delivery. Whenever the customer wants it, they will deliver it. By 30th of June 2026, Hickson Co. has transferred 100 of these units to the customer, and Hickson Co. has recorded revenue of 4,000. Okay. However, the total value of the goods was 12,000, but Hickson Co. has only recognized the revenue $4,000 based on the fact that 4 months of the agreed 1 year holding period has elapsed. Okay, so here it's a simple case of this. They must recognize the whole of the revenue. Okay, the treatment that they have done is not correct, because it is a simple case of bill and hold arrangement. Okay, the goods are sold. Okay, so in that case, the total sales revenue of 12,000 should be recognized. It is only that the customer does not have the facility, that the goods are with the business. Okay, otherwise the goods are considered sold. So the total revenue of 12,000 should be recognized, and Hickson has not followed the correct treatment here. Fine. The information provided here is clearly said that those goods are set aside as belonging to the customer, and there is no situation, or there is no condition attached that this customer can uh, return the goods, or they might say that they do not want it. There is no such thing. Okay, the goods are sold. So when this is the situation, it is considered a sales, and the whole revenue should be recognized. Okay, so let's also look at what the ACCA rationale is there, what is their feedback, so that we have a better understanding. Okay, so this is your let's see. So if we, yeah, this is a simple bill and whole arrangement. Control of the goods has transferred to the customer. Since there is substantive reason for Hickson continuing to have physical possession of the goods have been separately identified and cannot be used by Hickson. Okay, they are regarded as belonging to a customer. The goods are ready for immediate dispatch. Okay, they are available for delivery immediately. These are the words in the question. Therefore, revenue is recognized when the sale is made. Okay, so this is the situation of these items. Okay, so we have concluded all the questions related here for this OTQ. I hope you understand this much. So the revenue of 12,000 should be recognized. The question does not ask us should be recognized. The question is not asking about the treatment because they have only recognized the treatment of they have only recognized the revenue of 4,000. However, they should have recognized the total revenue of $12,000. Okay, so I hope this is fine. As we have progressed in this section B, we have seen that the questions are not all that easy. Even the theoretical questions were challenging. We might have gone through them quickly, but they were not easy. I hope you people are comfortable. So far, with the questions that we have done, we have concluded two OTQs. That means we have done 10 questions. Okay. So you could only understand those questions if you had the relevant idea. For example, the lease item, the sustainability development, and all that. Okay. So people, the next challenge is the section C, which is related to the consolidation. It's a really good and challenging question that we have. We're done with the section B now, and the section C has this consolidation question. It's a 20 marker where we just have to make the consolidated statement of financial position. Okay, so I believe we could have a short break of 15 minutes, and then we would be fresh to attack this consolidation question because it will have all the major workings. It has the goodwill working, it has the retained earnings working, it has the non-controlling interest working, it has unrealized profit working, it has the depreciation related to fair value adjustment. Okay, so it is going to be a really good question that is going to make you revise a lot of details, and you will also be able to understand the basic concepts behind the consolidation in a better way. Okay, so should we start it or should we take a short break of 15 minutes before we attack this major question?
Let's take a short break so that we can go out to stretch.
Exactly. Okay, because this is going to take some time.
Yeah.
Okay, so it's a 15 minutes break. I have yes, this is around 9:30 or something, 9:27 my time. So let's start at 9:45. Would it be fine? I will just write it here, starting in 15 minutes. Okay, so you people could also get something to drink and get charged for this major question. Okay, so I'm just going to put it here, and I don't go away. Stick to the meeting, and we're going to start. Okay. Break. Starting in few minutes. So that if someone comes in between, they know what is going on, because yesterday a student came and they had no idea what was going on. Where is everyone? So that's why I am writing it here. But if someone joins in late, they do not get confused at what the hell is going on. Where is everyone? So people, enjoy your break and come back charged with charged batteries. So I'm just going to pause the video here and we're going to proceed. Students, welcome back. We are looking at section C. The first question in section C is related to the consolidated statement of financial position. There are variety of areas which the examiner can test in consolidations, but here they have given us the question that is related to the consolidated statement of financial position. Okay, so let me just put the whole thing together. so that you could see it properly. We will underline everything so that we do not miss out on any important detail. So the main requirement goes down, that is, prepare the statement of the consolidated statement of financial position of Panama for this year, or rather at 30th of June 2007. Okay, let's see what are the challenges that are available to us. Let's go through the information. We have fine the important details like the controlling interest and other details. Panama operates in a manufacturing sector. On 1st of March 2007, it acquired 75% interest in a supplier. Okay, so here they have got this 75% interest in this supplier. So what they are doing, they are going as a in a vertical backwards integration. Okay, they have taken over their supplier. They are in manufacturing, they are in the secondary sector, and they have acquired their supplier. Okay, so they want to secure the suppliers here. So that is the 75% shares that they have bought of their supplier. The name of the supplier is Tribly Co. In exchange for $200,000 cash and one of its own shares for every four shares acquired in Tribly Co. So the consideration is based on cash and share exchange. Okay, so the financial statement, financial position of the two companies at 30th of June 2007 is as follows, were as follows. So the important detail, when did it took place? It took place on 1st of March, the acquisition, and it's a 75%. So the important thing that we need to identify is what is the post acquisition period. This is a mid-year acquisition. They have acquired it in March, and the year end is in June. So which means that March, April, May, and June. So this is a very important piece of information, that the 4 months is the period that is post acquisition. All the information that would be regarded as pre acquisition. Okay, so these dates. So I will just underline or put it in this way, that these are important details. The 75% holding, 25% is the non-controlling interest, and it's a mix of share exchange and the cash proceeds. Okay, the cash consideration. So let's see. So we have this the non-current assets of both the companies, PPE. We're simply going to add these. There is investment property of Panama, and this investment. So it seems that they've only recorded the cash portion of the consideration, because the 200,000 is in cash and they have given the values in thousands. Okay, so let's see. In the current assets, we have inventory, receivables, and cash. And what we're going to do in consolidation, we're going to add everything, add the inventories, add the receivables, and the cash. When it comes to equity, we're only going to take the equity of the Panama, the parent company, the share premium of the parent, and we're going to have the consolidated retained earnings. So we will have the retained earnings of the parent and the post-acquisition retained earnings of the subsidiary and other adjustments. Obviously, it's the non-current liabilities are 180 and 40. They are just going to be added. We have the current liabilities. They will also be added. That is 105 and 32. So just going through this information so that we have better idea of what are we provided with. So now comes the serious business, okay, which is related to the adjustment. So I will just go through the adjustments and I will do the workings in front of you so that things become easy. So we will attack the major workings later on, but we are going to look at these smaller workings like the intercompany sales, the unrealized profit, and things like that. Fine. So let's see what sort of challenges we have. The following information is relevant. Panama has recorded its investment in Triblico at the amount of cash consideration and has made no entries for the share consideration. So this is what we have already seen, that we could only see the cash consideration. Okay, we haven't looked at anything. That's why they have made no entries for the share exchange. Okay, so let's see. Let's do the entries for the share exchange. Let's do the calculation for that. At the acquisition date, the market value of Panama Co share was $10 because Panama Co is giving one of its share for every four bought in Tripoli, and the market value of Tripoli Co share was 5.9, which is irrelevant here because we are just going to take their shares, like just look at the total number of shares that we have taken over and multiply them to our share price. Okay, so I'm just going to do this working in a while before we go any further. Both companies' shares have nominal value of $1, and Panama has elected to measure the non-controlling interest in Tribrico as a proportion of net assets. Okay, so this is so first of all, we will have to add up the net assets of Tripoli, and then we are going to take that value as the non-controlling interest. Okay, so let's see. I would just like to calculate the share exchange. You could just have this short working here. The share exchange portion of consideration. So that is we need to see how many shares Tribly has, and then we will be able to understand. So I'm just going to clear the drawings here. So we have this. They have 80,000 shares, and we have just come to know that the nominal value of the share is $1. I'm just going to again highlight the important details that the nominal value of share is 1. So which means that if it is 80,000, all the figures are in thousands. So if it is 80,000, then it clearly means that this is 80,000 shares, and we have bought 75% of these shares. Okay, so let's see. So we have this 80 multiplied by 75%, and we then divide this by divided by 4 shares multiplied by the share price of Panama. Okay, so this is going to help us calculate the share exchange part of the consideration. Okay, so out of 80, 75% have been bought by Panama, that is 60,000 shares, and we divide this 60 divided by 4, so that is going to be 15, and for every 15 we have this $10, so we take this 15 multiplied by $10. Okay, so that is going to be 150. Okay, so we will be considering all the values in thousands. Okay, so that is 15. So this is the share portion. I hope this thing is clear, and we will be looking at the other aspects like the impact on the share capital and share premium. So let's get done with this part here. So this one, the nominal value of shares is $1. So you see, we have valued those shares at 10 per share. However, only 15,000 shares have increased. Okay, so this means that the share capital will increase by 15, and the share premium will increase by 135, because the total portion of the share exchange was 150. Out of that, the nominal was 15, so the remainder goes to the share premium. Okay, I hope this part is clear. That because we have only issued 15,000 shares. How I have calculated that? That is 60,000 shares, or we could say 60, just to simplify the things, 60,000 shares in this company Trilby The name is Trilby. And one share of Panama or every four in Tripoli. Okay. So that equals 15,000 shares. Okay. So I hope now it helps you understand. So if it is 15,000 shares, so the share capital will increase by 15 and the share premium will increase by 135 because we have increased overall the number of shares that we have increased or the portion that is related to shares has a worth of 150,000. So out of that, only 15, we have only issued 15,000 shares. So clearly, anything above the 15,000 would be regarded as share premium. Okay, so this was an important point which we will have to deal with while we calculate the equity portion in the consolidated statement of financial position. Okay, so I hope this one is clear. We are done with this first part. I've tried to calculate all the aspects related to this thing. Okay, definitely we are going to use this figure in the calculation of the goodwill. Yes, people, are we comfortable?
Yes, when I did, I wasn't sure of the nominal value, like how to do it.
Yeah, it's here.
So I'm glad, yeah.
The nominal value is given. Okay. So that's
Yeah.
quite important to see. Okay, so if everyone is comfortable till this part, so we could move on to the next one. Okay, let's see. So the next area that we have is at 1st of March, that is when they have acquired the company. At 1st March 2027, Triblico's property had a fair value of 36,000 in excess of its carrying amount. The property has a remaining useful life of 20 years. So this is related to the fair value adjustment, and this is going to have depreciation consequences. So we will have to calculate the additional depreciation, and this will be used in the calculation for the goodwill, and we will have to add this increase in the fair value of this property when we add up the non-current assets. Okay, so this is one part, and so let's just deal with this as a working. Okay, so we if we say this that is the working two, where we have the additional additional depreciation additional depreciation for the fair value adjustment. Okay, so this is going to be this 36. Let's do it in proper 36,000 divided by 20 years multiplied by 4 by 12. This is the period that is after the 4 months is the post acquisition period. Okay, so we deal with this. I hope this part is clear. So that is going to help us calculate the depreciation. So that is 36,000 divided by 20 years. That's going to be for 1 year, and 1,800 into 4 by 12, because the post acquisition period is they acquired this company in March, April, May, and the year end is June. So this is the post acquisition period. That's why we have done the 4 months. Okay, so that is 600, or we could call it 0.6 in thousands. Okay, so that I've just done this in a way so that it does not confuse you. Okay, so we're actually going to deal with 0.6 when we're going to do all the workings, because my workings are going to be in thousands. Okay? So this is the additional, and the consequences are add the increase in fair value adjustment, the in the non-current, or we can just say in PPE. We're just going to add that thing, and this the additional depreciation would need to be dealt with in the retained earnings. Okay, so when we're going to make the retained earnings, we will recall this thing. The additional depreciation on fair value will be dealt in the retained earnings and NCI working it. So it will be easier to relate to. So we're done with this part. We've calculated the depreciation. Now let's move on to the next part. So this will actually make things easier for us when we go and attack those major workings. Okay, let's see. What is the next thing? So it was 20 years, 36,000 was the value, and we knew that it is from 1st of March to 30th of June. That is the period. Okay, now there is another twisting adjustment coming up. In the year ended 30th of June 2027, Trilby Co made a profit of 33,000. Okay, so you see, we haven't acquired this company at the start. We have bought it mid-year. Okay, so the post acquisition profits are going to be the 4 months related to this. So 33,000 is the profit for the whole year. When we want to find the post acquisition, we're going to multiply this to 4 and divide by 12, and this is going to help us use this figure in the goodwill calculation and in the retained earnings calculation. Okay, so let's see, we will have this another working. Let's call it working 3. The working 3 for the this post acquisition profit. So that is going to be the total profit for the year is 33,000. We multiply that to 4 by 12, we will have the post acquisition. So that is going to be 33,000 into 4 by 12. That is 11,000. Okay, so this will be useful in goodwill. I'm just writing those extra notes for you people to understand. You're not expected to write them in the exam. Okay, so this will be useful in goodwill working and in the retained earnings and NCI working. Okay, so we have calculated the value, and because you see this is the same 4 months, I will write them again. This is related to March, April, May, and June, so that you do not get confused. This is one major thing which is going to be in almost all the workings. Okay, this period, because this is not the full year acquisition, it's a mid year, so we will have to cover this aspect. Okay, so that we do not get it wrong. So we're done with step by step. We're moving on, dealing with adjustments and deciding where they are going to be required. Okay, so let's now. So we're done with this fair value adjustment, the profit portion. They say that these profits which accrued evenly. So that's why we have easily multiplied this into 4 divided by 12. This was considerably lower than in previous years. So this they say that Tribuly's profit is going down, and this profit is considerably lower as compared to the previous years. Okay, so due to that, Panama co-directors were aware that Tribuly Co was struggling to control costs, and prior to the acquisition date, they had already decided to restructure Tribuly Co's business to eliminate the layer of management. Okay, so they are going to fire some of the employees, and this will lead to some redundancy cost. Okay, so they say that the Tribly has a lot of employees, and obviously whenever the takeover takes place, some of the employees lose jobs. Okay, so a whole layer of the management is going to be laid off, and that is going to be that is going to have some consequences in terms of the redundancy cost. So the redundancy cost of 60,000. Okay, so this the restructuring plan was introduced was announced to Trilby's co-staff members on 20th of March 20x7. Okay, so the acquisition took place on 1st of March, and on 20th of March this was announced. Okay, so clearly we have to create this provision. Yes, what is the question?
Yeah, I'm looking at the treatment for the post-acquisition profits
Yeah.
of the 4/12. I see that the profit we have is for the year ended, and we're preparing the financial statement as at 30th June. So I'm just looking at how we arrive at prorating it for 4 months.
Yeah,
I'm
because
just
that is what I've been mentioning here again and again. Like, we have made the acquisition in the month of March, so we had it for April, May and June. This the starting of this the starting date of their business is 1st of July. Okay, but we have
Okay.
bought it only in March. Okay,
Okay.
so
Yeah.
only the 4 months belong to the group. Okay.
Okay. Thank you.
You're welcome. Okay, so we come back to this restructuring plan. So this is IAS 37 in practice here. We have to create a provision for this thing. So that is going to be added to the liability, the current liabilities. So and this will be reported in the retained earnings and in the NCI. Okay, because this is the cost related to Trilbiz. So let's see, let's add this note here so that you people do remember it. So this is related to, let's add another working to it. Okay. Let me just squeeze this one so that we could have this slide, this working for, or just a note here to make sure you remember. Note on the this redundancy. Redundancy cost. This 60,060 will be added. The current liabilities, the consolidated current liabilities, and treated in the retained earnings and the NCI working. Okay, so that we remember it when we are dealing with it. So this part is done too. We had this another issue sorted out. So we're still in the minor issues. Okay, the major issues will be when we look at the goodwill working. Although we have covered some aspects of those major working as well. So we're done with the fair value adjustment. We're done with the profit adjustment. We have done with the this redundancy cost, and now the next challenge that they are giving us, the restructuring will commence in July 27 and be completed. So clearly we have to create the provision, although it will commence in July, so we have to have this liability and complete it by December. So clearly this will be done in the upcoming 12 months. Okay, the the intended restructuring costs are not reflected in either. So clearly if they are not reflected, so we will have to show them. Next one, throughout the year ended 30th of June 2027, Panama has bought $8,000 goods from Tribly Co per month. Okay, so now from the acquisition, they have bought 8,000 worth of goods from Tribly, because Tribly is their supplier, so that's why they are going to sell it. Tribly makes a profit of makes a markup of 25% on these sales. So the sales per month is 8,000 and the markup is 25%. So obviously there is going to be some unrealized profit and all that. So we are now going to deal with the unrealized profit element as well. Okay, looking at the next thing. At 30th of June 2027, Panama Co. still held all of the goods bought in May and June. So here, this is a very important point to remember here, that this is we only have the goods at 30th of June 2027. Panama still held all of the goods bought in May and June. So the goods bought in 2 months. So we should not be considering all the 4 months here. The goods that they bought in May and June are still held by this Panama, and which means that the unrealized profit is going to be for 2 months. Okay, it still owed Triblico for all the goods bought in June. So that's another important information they have disclosed, that the intercompany balance is only going to be for 1 month. Okay, because whatever is still owed to Tribly, it's still owed Triblico for all the goods in June. For 1 month, they make the purchases of 8,000 and they only owe for 1 month. Okay, but the goods that they have in their inventory is for 2 months. So this is important point. So I will just go through this working afterwards. I hope you understand that since they are buying products, they Tribly is their supplier. So Panama has bought goods worth 8,000 every month. However, they only have the purchases for 2 months, that is May and June, and the balance that is due is only for June. So the intercompany balance is only going to be for 1 month. However, the unrealized profit is going to be for 2 months. Okay. I hope this is clear because this is very important. It's a lot of like, it's very twisting point. You could easily take the 4 months, but they have given extra information from which we have to look at it. Yes, there is a question.
Yes, sir, thank you. I wanted to find out the reason why we going to add the redundancy cost to the liability. Is that because of IS 37?
Yeah, because you
I
see,
just wanted to
they have
understand the reasoning behind. Yeah.
they have made the announcement here. You see, this we acquired this company on 1st of March, and they have made this announcement, and this is well known. This is mentioned here. The restructuring plan was announced to Tribly Co staff members on 20th of March. Okay, so they had acquired
Mm,
the company on 1st of March, and they have announced the plan. So that's why when they have made the announcement, then they must make the provision. Okay, and why we are going for the
mm,
liability part is only that the whole restructuring or whole the redundancy process or laying of the workers will be done in the upcoming year. Okay, they have mentioned it here that
mm,
this would be covered,
mm,
completed by December 27th. So this is very important.
mm,
Okay.
okay. No, I see it now. Yeah, I see
Very
it.
good. So the
Thank
next,
you, sir.
then you're welcome. The next major working would be related to this unrealized profit. So we have the working four here that is related to this unrealized profit. Unrealized profit for the months are May and June. So that would be the total sales are 16,000 because you see every month they have got this 8,000. So we multiply this by 2 and we have got 2 months sales, that is 18,000. So the profit is 25 a markup. So we divide it by 125 to calculate the total value. Okay. So let's see the total profit is 16,000 into 25 divided by 125. So that is the total unrealized profit. Of this unrealized profit, what goes to the retained earnings is going to be 3,200 multiplied by 75%. And what goes to the NCI would be this 3,200 into 25%. Okay?
The next stop is Shadwell. When leaving the train, please remember to take all
Us calculate the values easily. Okay. So let's see how we can break this thing into 0.75 and into 0.25. So we, since it is the subsidiary who is making the sales, or if we have these values in thousands, because the workings are going to be in thousands, that is going to be 2.4, and this is going to be 0.8. Okay, so let's calculate it too. I have rounded it. So if we unround these figures, so this is going to be the values. Okay, so in thousand, these are going to be the values. So we have calculated the unrealized profit. I said that this is for May and June. So the unrealized profit total is 3,200. What goes to the retained earnings and what goes to the NCI? Okay, now comes to the intercompany balance. The intercompany balance would only be for the month of, which is mentioned here that the intercompany balance is only for the month of June. Only balance for the month of June purchases. So that is 8,000 or 8. Okay, because 8 in thousands, because we're going to do figures in thousands. So that is done. So whenever we're going to add the receivables and the payables, we're going to eliminate the 8,000. Okay. So I believe we are done. I'm just explaining every bit of it so that when we attack the major workings, the retained earnings and the NCI, things are easy for us. Okay. So
Yes, sir. Sorry.
yes, please.
Yeah. So, is it okay for this question for one to adopt the net assets table wherein you just get the growth, the difference? Would it be easier?
Yes, we are going to calculate the net assets. Okay, I haven't reached at that point because that will be used when we look at the goodwill working. Okay, I'm going to make that thing. Don't worry.
Okay.
Okay, so let's see. We have reached here. I'm just going to clear the drawings because we are moving on. The drawings don't make sense. So we were done till this point, and now we're looking at this last paragraph. Okay. Yes. What is the question?
So if we wrote like this on the exam, would we still get marks for it?
Obviously,
Just
you see, doesn't it make things easy?
it does, yeah.
Because you see, you tend to forget a lot of information. If you do it, that will make your life easy. Okay.
And would still get rewarded marks just for
Obviously.
doing these workings.
Yes, yes. These are just small workings, which you have
Yeah.
to do them anyway.
Okay. Now I'm asking to say if we just put it like this, let's say you're in the exam and you just write this, maybe you're out of time, would you still get marks for it, or you only get marks when you put it in the when
No,
you're done
yes, you would
constructing
get
it?
marks. You would get marks. You would get marks for those working if you're getting late. But that you see, usually you would end up late on the second question of section C. So you will have to complete this part anyway. I wouldn't
Mhm.
recommend you to leave the question undone. Okay, only till the workings part.
Okay.
Okay, you see,
Thank
you would
you.
given the benefit of doubt in question two, or if you are doing this question at the second number. Okay. Are you
Okay.
understanding my point?
Yeah.
Okay,
I think you're saying that it's very important we do it at all costs, so would
exactly.
rather
We
maybe
only
leave.
we only leave it if
Yeah.
we are really in a tough situation in terms of the
Yeah.
time available. Okay,
Yeah. Yeah. Okay.
okay, but that can be done. Okay, you can do this thing. This is the examine the markers would accommodate it. Okay, so let's see. Here we go. We have this last one. Panama Co acquired its investment property on 1st of June 2007. The property cost 144,000 and had a useful life of 50 years when it was acquired. So they have this investment property and they say that it has a value of 144,000 and it has a useful life of 50 years. Panama Co directors have decided to adopt the fair value model for investment property. So they were following the cost model, but now they're going for the fair value model and have been advised that the fair value of the property is $170,000. Okay. So now the value has increased, and obviously, since now they're following the revaluation model, the fair value model, they're going to increase this value from 144 to 170,000 at 30th of June 2027. Other than recognizing the property as cost, no accounting entries have been made. So, their property is recorded at cost. So when they record it at the fair value, then they will have to restate it from 144 to 170, and the gain that is going to be there will be taken to the retained earnings. Okay, so we could just add another working here for this working 5 for the investment property. So we have this gain of the gain is, let's calculate the value. This is the new value is 170,000. We take away the 144,000 and we will have the gain. So let's calculate the gain here. That is 170,000 less the 144,000. That is 26,000. So this will be the value will be taken to the statement of the consolidated statement of financial position, and the gain will be added to the retained earnings. Okay, so that's about it. These are the only adjustments. That was the last thing that we looked at. Okay, so we are going to record the this investment property at 170,000, and we're going to take this gain to the retained earnings. Yes, what is the question?
Yeah, I'm looking at the investment property. The 50 years there, we don't depreciate investment
Yes.
property, right?
See, because we are not following the cost model. Okay. If we were
Okay.
following the cost model, we would have considered that. But still, now since they have changed it and they say that the time when this changed the method, it had that value 144. Okay, so we're not going to do that. Okay.
Okay. But if we're to follow the cost model, we'll have to do that. Right?
Obviously, yes. That would be the same as the IS 16. Okay. Okay, people. So now we are all set. We have dealt with all the small workings. I would now go for the major working, which is the three major workings, which is goodwill. So let's look at the goodwill working first, and that would be your working 6 here. Okay. So we have this the cost of investment. We have this the cash consideration, which was provided to us in the question, which was 200,000. We had calculated the share exchange. I guess that was working 1. That was 150,000. Let me just check whether we are referring the right working. Yeah, that was working 1, where we calculated the value, and if we follow the now, since we are entering and doing the working, so let's follow the 200, the 150, and all that. So, and then we have the NCI, which is valued at the net assets. Okay, so we will have to have the net assets first, and then we could calculate the value of the NCI. Okay. Now we have this the net assets. The net assets of Trilby. We have this the share capital. We have the retained earnings. So let's look at those values. I would just bring that piece of information down so that it becomes easy, because we have dealt with the other information. Now it will be easy. We won't have to scroll up and down because the information is now in front of us. Let's see. Okay. So that is the requirement. We will just take it down. We could bring this information here. So now we have everything in front of us. We have the share capital of Trilby, which is needed here. It is 80. So I think we need some more space here. Let's take it. Okay. I think this will suffice and we can manage now. Okay, so now we can deal with it. We have this, the share capital of Trilby is 80. We have bought 75% of it. The retained earnings is 371. This retained earnings figure is at 30th of June. Okay, so we have to basically deduct the post-tax profits, which we have calculated in a working, which were 11. If we take away that, I would just put the relevant working here so that it becomes easy to understand and remember. So that was, I guess, the post-acquisition was working 3, where we calculated that the profit for the year was 33, and we calculated it for 4 months. That was 11,000. So since we have this retained earnings, I would just write it here so that it becomes easy to understand. The retained earnings at the year end, 30th of June, X7. So since we have bought it in March, so we will be taking away the post-acquisition profit so that we arrive at the retained earnings at the date of acquisition. Okay, so this is the piece of information that we need to have. Then we have this the fair value adjustment that we were given, that was the 36. So once we are done with these details, we will have the value of the net assets of the company. So let's figure this thing out. What is the value here?
Going to add the share premium as well.
This company does not have the share premium. Okay. Because we're looking at the subsidiary. Subsidiary has the share capital, the retained earnings. Okay, and this was the fair value adjustment. So we will be taking away the 476, and we can now have the value of the net assets, which is 476. multiply by 25% since we have calculated the value. So 476 multiplied by 25%, that is 119. And the total value here is 469. And let's see, let's put so that it makes sense. So the total value is 469. Yes, what is the question?
Yes, I'm looking at the net assets we are looking at. I thought the net assets when calculating goodwill is at acquisition.
Yes, that is what we have done. We have taken the share
We
capital. We
say
have taken the
earning that at year end 30th June, which consider the retained earning for the year which comes after acquisition. Why are we also considering it at I'm just thinking.
You see, this is what you're missing out. We are deducting the post acquisition profits, which we calculated as 11,000. Okay, I would just do the working again for you if it is confusing you. The profit for the year were 33, and if we take away the profit for the 4 months, we would arrive at the retained earnings at the date of acquisition. Okay, we've already discussed this thing. That's why I've referred the working here.
So assuming if I was using the net assets table, wherein I have a column for acquisition and reporting to get the growth, which makes the work easier for me to just calculate the
Yes,
NCI
you
percentage.
you could follow that approach, but I would say that this is the only, because this is not the conventional question where you are provided the retained earnings at the acquisition date. Okay, we're not provided with the retained earnings at the acquisition date. We have to find it out. That's why it's inconvenient to follow that approach. Okay.
Okay, because usually I would have just
Yeah.
added the
Usually,
371
in normal
plus.
circumstances, you are provided what was the retained earnings at the acquisition date. Here, they have provided us the total retained earnings, and we have to take away whatever are the retained earnings after the date of acquisition. Automatically, we are left with the retained earnings at the date of acquisition. Got it? Okay, very good. Yes, I hope we are fine. We could just see this thing that in the year ended 30th.
Also, sorry, I wanted to know,
Just,
most of the questions I have been able to
yes.
work on is NCI at acquisition. Do
Mother,
we also the
just give me
NCI at proportionate, the same way we treat NCI at acquisition? That's the fair value, that's NCI fair value. Is it the same thing as this NCI net assets? Fair value of NCI at acquisition.
yes, because in this question it is different. They haven't provided us the fair value of net assets. They say that the net assets are valued at the net assets at the date of acquisition. The non-controlling interest would be valued at net assets. Okay, so I will just show you that adjustment that they gave us, that how to treat the non-controlling interest. Okay, let me show you. It was mentioned because you see, there was a lot of information that we had to go through, and we read it, and it was mentioned that the non-controlling interest is valued at the, yeah, this is the one. Panama has elected to measure the non-controlling interest in Trilby go as a proportion of net assets. That's why we have done that. Is it clear?
Yeah, okay.
Okay, that's good. You see, because you see, this question had a lot of information, and we read it everything, and that's why I wrote everything. And I did not cover this area before because we had to calculate the net assets, and only then we could do that. Okay, so here we go. We have this the total value of Trilby, and we have the net assets of Trilby. So let's see what is the situation here. It seems, yes. What is the question?
So the net assets that we are calculated there, I just want to understand the share capital is at acquisition date, right?
Yes.
Oh, and then the 371 is at reporting date, or
Yes.
and then The 11.
11 is the post acquisition profit. If we deduct the post acquisition profit from the total retained earnings, we would arrive at the profit at the day, or the retained earnings at the date of acquisition.
Okay. So what is the total of the net asset at acquisition? Is
That
that
is
the
that is 476.
476? Okay. So we work
That is
on that.
that is why we take 476 into 25% as NCI.
Okay. All right. Thank you.
Very good. Welcome. So we're now in the situation to calculate the goodwill. So can someone calculate the goodwill for me? Can you people do the math for me? What is the goodwill? Yes, people, quickly. What is goodwill?
It's 7. 7.
7. Is it
Yeah.
really goodwill?
Yes.
Are you sure?
Yeah, because it's the
It
469
is
minus
not goodwill.
476.
It is not goodwill. It is bargain purchase. We have,
Oh,
you see, the net assets have a value of 476, and the value that we have provided is only 469. So that is a bargain purchase, and that
makes
could be
sense. Yeah.
reported as gain in retained earnings. Okay, so this will be taken to the retained
Yeah.
earnings as well. Okay.
Yeah.
So you see, there was a lot of twisting information. Usually, when you get such a thing in exam, you will be really troubled. What is going on? You must have made some mistake. Okay. Okay. So I think now we're all set for the major working, which is the retained earnings, and we have a lot of content that we could put in the retained earnings working. So the retained earnings, or we could say the consolidated retained earnings. Okay. So for this one, we first of all have to have Panama's retained earnings, which are mentioned here. So let's see what they are. Then we have the post-AC retained earnings of Trilby, TRILBY Trilby, and those are only 11. The post acquisition, and we multiply that to 75%. Okay, we've already calculated that the post ac are only for the 4 months, so that the profit for the year is 33. We took it for 4 months, that is 11. That is done through a working, so that is 75%. So that is one portion that we have calculated. So let's see, 11 into 0.75, and we are going to have all these figures in so you see, I've got everything rounded, so I'm just going to unround everything so that it makes sense. So the post-acquisition retained earnings of Trilby is 8.25. Let's check the retained earnings of the parent, which is 518. This is the information for Panama. So that is 518. There we go. This is 518. And then we have a lot of adjustments. So I would just go for the working of the NCI at the same time. Okay, so that is going to be your working 8. That is for the NCI, and this the consolidated retained earnings working is the working 7. Okay, so we have got everything in working so that our life becomes easy. The previous one was the goodwill was working 6, and we have this working 7 as retained earnings. And you see, a lot of information is going to be kept in the NCI and the retained earnings. Okay, so we have this the NCI at acquisition. We calculated this as the in goodwill. This was 119. 476 into 25 is 119. So let's deal with that. And we have this the post-AC the post-AC profits of Trilby, which will be included here, which is going to be 11 into 25%. You see, 75% is dealt here, and the 25% is dealt here. So this will make things easy for you. So that is so we are maintaining both the workings. Then we have some other adjustments that we need to see, but I would like to add these details, like which are in front, the bargain purchase. The bargain purchase will be, treated as a gain in the group retained earnings of 7, and then there is this the other things, which is the unrealized profit. The unrealized profit is by the subsidiary Trilby, so it will feature both in the unrealized profit, feature both in the retained earnings and the NCI, the unrealized profit. So we have done this working. Let me just check which working is it. So this was the unrealized profit is working 4, and it is the 3.2, and we've already calculated it as 2.4 and 0.8. Okay, so let's see. This is working 4. This is working 4, and this was it was 2.4 here, and it was again, this is, let's write the working number here, working 4, and this is this 0.8. Okay, that is 0.8. So this is the unrealized profit, and we also have to deal with the additional depreciation. The additional depreciation, this was also in a working. This was, let me just write the working number here. This is working 4 for the unrealized profit. Let's see what is the working number for the additional depreciation. So I guess this is the additional depreciation. This is working 2, that is 0.6. So we have to separate it in terms of the retained earnings and the NCI. So that is working number 2. So that is working 2 here. So working 2, and this is 0.6. This is for the retained earnings, so that we take the 75% of it. So that is 0.6 into 0.75. That is minus 0.45. The total additional depreciation, that is for 4 months, is 0.6. And what goes into the retained earnings is 0.45. And the balance goes to the NCI. So we have the additional depreciation. So that is going to be coming from working 2. That is going to be 0.6 multiplied by 25%. That is going to be the balance 0.15 minus 0. Okay, so we are done with this another portion. There is one more thing which is related to the redundancy. The redundancy cost, the provision that we had made, this was for 60. So again, this portion goes 75% to the retained earnings. So that would be again 45, and the portion that goes to the NCI, the redundancy. And so that is going to be 60 into 25%. Okay, so that is going to be 15 would be deducted here. Okay, so we have the bargain price, and there was this one last thing which was related to the investment property. Investment property gain. That was we had this 170,000, and I think we did a wording for that as well. That will be easier to relate to. Investment property, we had this gain of 26. Okay, and when we wrote that this will go to the retained earnings, so that is 26. That is working 5. So investment property working 5, and that is 26. So that's about it. I hope we have considered everything. We are done with the unrealized profit, the additional depreciation, and we have done that in both the areas. So I believe we're all set. Yes, so you can help me if anything is missing here. We could just add up the whole thing. We will have the figure for the, yes, What is the question?
Yeah, I'm still trying to wrap my head around this post acquisition and how it's also being treated under NCI. Because I see the post acquisition profits of 3B, 11%, 25% of it.
Yes, you see,
And,
yes. What is the profit for this year? It is 33. Okay.
yes.
And how much is the?
Let me just learn. What I'm trying to look at, because I understand that is the post acquisition that we capture in the retained earning, that's the consolidated retained earning, and
Yes.
share it between the NCI. Now, but when computing for goodwill, net assets should be at acquisition. So I was thinking that why are we deducting that 11 and we are calling it the profit post acquisition? Because if they've been given profit for the year, we've not been given retain any or profit for the year before acquisition, but we've been given and it is spread evenly. So meaning that we can determine profit
Would you give me a
before
chance here? That the total retained earnings at the year end, that was 30th of June, is 371. Okay, that is June 30th. Okay, this is the figure. Fine. And if we take away less the post acquisition, the post acquisition profit is 11, which is 33 into 4 by 12. So we would arrive at this 11, and when we deduct this 11, we would arrive at uh, the the retained earnings of Trilby at acquisition date, and that would be the difference of the two. I hope now it makes sense. I think what is confusion is, okay. Is it clear now?
Yeah, it's clear. Thank you.
Because you see, we have deducted that, but we haven't calculated the net value, and that is causing confusion to you. I hope now it makes sense. These are the same workings.
Yeah, it's okay.
Okay, that's very good. That's very good. So yes.
So the total post acquisition, we can say it's 47, right?
The total cost of
The post net assets post acquisition, it's going to be 47.
yes, you're talking about what? The post acquisition profits.
No, like the net assets of the subsidiary at
Yes.
acquisition. We've got
Yeah.
at reporting debt, it's 487, and
Yes.
then at acquisition is 360. Now post acquisition net assets will be how much? Is it 47?
Yes, that is what we have calculated. You want me to look at the values, exact values to be calculated?
Yeah, is it just 36 plus 11?
Okay, let me go to that figure and show
Yeah.
it to you. What you are trying to make up so that we could understand. Okay.
All right.
Okay, let's see what we have here. So let me see. Yes, you're talking about the value at the net assets value at
Yes.
the reporting date.
No, after the acquisition, because at the reporting date, it's a total of 487. We've got the 80, the share capital, we've got the 36, the fair value adjustment we did, and the
Yes.
371 return earnings. And
Yes.
then now at reporting date, we've worked backwards, giving us 360 plus the 80, right?
Yes.
For the share capital. So now I don't have a figure for the post acquisition, the net assets post acquisition.
So basically, we have calculated the post acquisition. I think you're trying to work this out according to the table.
Yes, please. Yes.
Yes. Okay. Fine. So we can do that once we're done with this last bit of working. We can work that angle as well for you. Okay.
All right. Thank you.
We're almost done with the major workings here. So this is your the consolidated retained earnings, and this is your the NCI. Let's calculate the value for that as well, because we're almost done with the workings, And we, first of all, let me just conclude this one, and then we can attack your question. Okay. So this is we are now looking at the position where we can make the consolidated. We have the retained earnings, we have the goodwill, we have the NCI. So it's just now matter of just putting things together. Okay. So we need to have some space here at the top where we're going to have the main answer. So let's see the consolidated statement of financial position as at, that is 30th of June, X7, I guess this is the right date. Let me just bring all the data here. These are the workings below, and now I'm going for my main answer here. So we have all the workings to refer. I just need these figures to make sure I add the right value for the assets. So what is the value that we're going to have for goodwill? Anyone? We have the non-current assets, and we have the PPE.
I'm thinking the goodwill it's a bargain purchase, which will be
Exactly.
captured.
So
as a
ignore it. You're right. That is 457. That is the Trilby's non-current assets. Then there was this the fair value adjustment of 36, and there was this depreciation, the additional depreciation of 0.6. Okay, so we could deal with these things in a working. Let me just relate to it so that you can understand. This was, I guess, working 2 here, the additional depreciation. Okay, so this 0.6 is coming from working 2. So we are done with this this first one. We summed up these 2 things. We added the fair value adjustment 36, and this is the situation. Okay, we have the investment property as well. We have already reflected the increase in the. So let's put it here. All the values in thousands, and we have got this as 170. Rather 170, and this is, let's sum this up. That is 480 plus the 457 plus the 36, and we take away the 0.6. I would just need to have these values in. I've rounded these. Let me just unround so that we could have the proper values here. So this is the figure so far. So we have these 2 assets, the PPE and the investment property. If we sum this up, we have the total of the non-current. And then we will have this, the next thing, which is the current assets. The current assets would have the first one as inventory. So we would add the inventory for the parent Panama, then 42 for the subsidiary. And we have this, the unrealized profit. So the unrealized profit was 3.2, which we calculated. Let me just share the relevant working for you for that. That was working 4, where we calculated the total unrealized profit of 3,200. So that is working 4 here. Let's refer this to working. So this is the thing we can get to the value.
investment property we are using. Is there a working of how we got 170, or is there a working on that?
Yeah, that value is provided to us, and that, yeah, because that is one of the adjustments. You're right that we can relate to it. That was, I guess, working 5.
Okay.
So that is working 5 here. Okay. And fine. So we are now coming to the receivables. The receivables are, we have this 41 for Panama. We have this the 24 for Trilby, and we have the intercompany balance of 8. I would, again, we will, I guess we did that in working 4, where we dealt with both the unrealized profit and the intercompany. You see, the intercompany was only related to 1 month, whereas the unrealized profit was related to 2 months. Okay, so this was another twisting information in this question. Okay? So there was nothing related to cash, so we could just have the cash for the Panama. Trilby has no balance. Okay, so we would just write it here. Let me just add the values. That is 10. That is let's see, 41 plus the 24 and let's 8. And then we have this 63 plus 42, and we take away the unrealized profit, which is, and let me just also unround the figures here as well, because I've got all the figures rounded. So that is the correct values. So that's about it. We have the assets. So when we sum up these one, we will have the total value of the assets. In the meantime, you could just have a look at if there's any confusion in this part, you can let me know. Yes, people. So we can now sum up the current assets, and then we can add them to the non-current to find the total assets. Let's see. Let's find out the value here. This is the sum of the current assets, and we have the total assets. We have done half the job. Let's sum it up. So that is one side done. The total assets are done here. Let's just put this here and this here so that you could see what we are doing. Okay, so we are done with this part, the asset side. And now we're looking at the equity and liabilities. So we would have the share capital of Panama. And you see, we had this adjustment for the share capital. The share capital is 100, and there was this added 100 plus 15, because that was the new shares issued. I would just like to refer to the workings here. That was, I think that was the first working, I believe. Yes, that's working one, where we calculated the increase in shares. So share capital, we wrote it as increase by 15. So that would be 115. There was this increase in the share premium as well. So the share premium was the opening share premium value is 35, plus we have the new 135. We could just add this is coming from working one. Okay, so that's done. We then have the retained earnings. We have, I guess this was working 6, I believe. Let's see. In working 6, we have no, working 7. That is 511.40. 511.4, and that is working 7. So that's the share. Let's calculate the value here. We have 35 plus 135. That is 170. We have the NCI here. NCI was working 8. Let's bring that value from down there. Let's see. So here we go. This is the NCI. So that is 105.8. So we're done with this equity portion. Now we come to the non-current liabilities. The non-current liabilities, we just add the liabilities that we have 180 and 40. There was no other adjustment here. So we could just add that as 220. And then we have the current liabilities. In the current liabilities, we had this, the sum of the liabilities, which is 105 and 32. And there was this intercompany, which was 8. We also dealt that in receivables. And we had this, the provision, the 60 provision here, okay? Because according to the information, this 60 was the current liability, because this restructuring would be taking place in the upcoming 12 months. That was mentioned here. So when we sum these up, we will have this value. So I hope we are fine. We haven't missed anything. So need some space here so that we could work things out properly. There is 105 plus 32 minus 8 and plus 16. Okay. So I believe this is fine. You people are comfortable. If there is anything that is confusing you, you can ask the question before we move on. Yes, people, are we doing fine?
Okay, yeah, we do fine. I just want most of these things, specifically when it comes to adjustments, the
Which
idea of knowing when, especially when it comes to like your intra-group fair value adjustments, things that have to, when consolidating, because after you've done the working, I know most of those entries we are doing after working is to obey the double entry principle. You have to post
yes, yes,
the
yes.
receivables, you have to
Let
post the
me
payables, you have to. So
let me
I want to
explain.
get, can you give us an idea of how to have that in mind so that,
Exactly,
because sometimes
exactly.
those are the areas that you just tend to, maybe you didn't capture it in this angle, you capture it there and you don't know. That's one area I feel I'm not yet
So
gotten.
you see, you need to understand the idea behind it. You see, we have to get rid of the intercompany balance. So when it comes to liabilities, the liabilities have a credit balance, and when we need to get rid of this balance, we have to debit the payables, and the same value would be credited in the receivables because we have eliminated that from receivables as well. Okay. This same 8 is being credited in the receivables and is being debited in the payables. That's why it's adjusted here. The unrealized profit is also eliminated here. So we're talking about the current assets. So when something is eliminated here, we would credit it here and we would debit this to the retained earnings, which we have done. 3.2, we have done that, debited to the NCI and the retained earnings. Okay. Yes, what is the question?
There's a point where they mentioned that they had not recorded the share exchange, the deferred. Is it the deferred
They
consideration, or
have,
maybe
it's not deferred, consideration, it is simply the share exchange. You see, they have recorded the investment in Trilby at 200,000. Okay. And
yeah,
when we looked at the adjustment, they mentioned that they've only recorded the cash portion.
yeah.
Okay, so that's why we have to record it. And when we recorded it, we had to update the value of the share capital and share premium. You see,
Oh,
all of this thing has come up in this way because we have done it in a structured way, supported
mm,
by workings for everything. Okay, we would like
yeah.
to just go for the working for this intercompany balance, which is let's see, it is working for. So let's add the working for here as well, so that when the people look at it later, that is working for.
Mm,
That was also mentioned. This, yeah, I mentioned here it working for as well. So fine, all the workings are related here. So let's sum it up. Hopefully this would be equal, the equity and the liabilities. So that is your total assets are equal to your liabilities. Let's just put that in. Oops, I had to make the changes for the break. Okay, so that's why it looks like that. So that is the normal pattern. So this was your 20 marker where we had to deal with a lot of workings, even the unrealized profit, the intercompany balances were not the usual ones. They gave the post acquisition period 4 months. The unrealized profit was for 2 months. The intercompany was for 1 month. So this was a very twisted question. There was a lot of information. So, but it's a detailed, really good question to understand the concepts. It had all the basic ingredients like the main goodwill, the retained earnings, and a million things in retained earnings working. You see, we had a very long retained earnings working and the NCI working. So that is how we concluded. Okay, so students, we are going to conclude it here, and I hope this this session was useful. Tomorrow's session will be focusing on some specific areas like EPS and other standards that you have identified. So I will be looking at some tricky questions relating to that. And then we're also going to look at the section C question that is left. Okay. So I can take your questions now if you have any questions. Otherwise, we can conclude it here.
Thank you. In terms of the format for this consolidation, do you prefer we use like one liner the way you've done here, or we use the one where you've got the parent, the one column the parent, the second sub,
I
then
don't
the third
advisable
adjustment?
because that is going to take a lot of time. How will you manage so much time in the exam?
Yeah, okay.
Yes. So yes, what is the question?
Yeah, I just want to ask, we have for me, I'm the first time writing an exam with ACCA. I want to know I know we have section A, section B, section C, and I want to know for this section, everything, is it done on Excel?
Yes, everything is done on Excel.
Okay. So you are not allowed to go in with a pen or a paper, just
No, all the workings have to be in Excel. Okay.
Okay.
Okay, there is this question that yeah, I will be sharing this whole Excel sheet. This Excel sheet will be available in the on VLS site. Okay, when we post this video, we will be putting the Excel sheet as well. Okay.
Thank you. Okay, it's okay then.
So that is all for the day. We conclude the session here. We will start tomorrow with the remaining section C questions. We will be attacking EPS and other important standards. I will see which ones we haven't dealt with. Okay. You're welcome, people. Take good care. And I will be uploading this material shortly. Okay.
Okay.
Okay, people.
Thank you. Thank you very much. Yeah.
You're welcome.
Oh.